Welcome to vTalkInsight, Allocator's Lens Daily from March 10th, 2026. A major Middle East energy shock is now colliding with sticky inflation, rising bond yields, and still resilient equities, leaving allocators wrestling with stagflation risk and stretched valuations. Let's start with equities, where the push and pull between higher oil, policy uncertainty, and powerful secular growth themes is increasingly shaping the risk and opportunity set. Equities are caught between an energy shock and surprisingly resilient risk appetite, producing big intraday swings rather than a clean risk-off break. We have seen the S&P 500 flip from sizable losses to solid gains within a single session, helped by occasional headlines hinting at conflict de-escalation, while volatility gauges have spiked above the low 30s intraday before settling back in the mid-20s. That combination says anxiety is high, but broad-based fear is still contained. Despite oil holding around or above $100, headline equity indices are only modestly lower, which suggests many participants either see the shock as temporary or remain willing to look through it. From a valuation lens, that resilience comes at a cost. Forward price to earnings multiples for U.S. equities are compressed from earlier extremes, but still sit above long-run norms, and stress testing with assumptions such as $100 oil, mid-single-digit inflation, and 10-year yield around 4.5% points to fair value for the S&P 500 in roughly the 6,600 to 6,900 range, implying limited upside from here. At the same time, consensus still assumes mid-teens earnings growth for the next couple of years and trend-like global growth, projections that look increasingly demanding if energy prices stay elevated and supply disruptions persist. Large research houses are already flagging that sustained high oil could bite into profit margins for the index, particularly in energy-intensive and consumer-facing industries. Beneath the surface, the index masks sharp dispersion. Energy stocks are clear beneficiaries of higher crude, with the sector outperforming as Brent and WTI hold above triple digits, while transportation names, especially airlines and cruise lines, have fallen into bear market territory, reflecting both higher fuel bills and concern about discretionary travel demand. European equities have moved into full correction since their February highs, with banks, retailers, and travel and leisure names under notable pressure, whereas U.S. large caps have shown more resilience, helped by their quality balance sheets and global reach. There is also a marked tilt toward companies with durable earnings that were not excessively crowded, including parts of consumer discretionary and staples, and a renewed bid for large-cap technology viewed as a relative safe harbor inside equities. The secular artificial intelligence theme remains a powerful counterweight to macro risk. Demand for AI infrastructure and related software is seen as structurally strong and relatively insulated from short-term economic or geopolitical shocks, with expectations that compute capacity will remain scarce for several years. Some large-cap tech names, including leading chip designers, are viewed as attractively positioned after periods of sideways trading and multiple compression, with earnings growth still expected to be robust even against a tougher macro backdrop. That said, positioning is a growing concern. Retail investors sit at record-high allocations to U.S. equities. Mutual fund cash balances are near historic lows, and hedge funds have recently increased short exposure to equity index products by more than 8%, a mix that could amplify any swing in sentiment. Liquidity and crowding add further fragility. Heavy concentration in broad index vehicles and private equity, combined with thin cash cushions, raises the risk that a deeper drawdown forces selling in the most liquid public names just as corporate earnings begin to reflect higher input costs. Strategists are now assigning roughly 1 in 3 odds to a U.S. market meltdown scenario this year, largely tied to the possibility that oil stays high, inflation proves sticky, and labor data keeps softening. Key signposts for allocators are the duration of the Middle East supply shock, the trajectory of earnings revisions in energy-sensitive sectors, and whether volatility spikes start to trigger genuine de-risking rather than the buy-the-dip behavior we have seen so far. Those dynamics connect directly into the next piece of the puzzle, which is the abrupt repricing underway in rates. Rates markets have swung decisively back to an inflation story as the energy shock gathers pace. Global bond yields are moving higher even as equities wobble, with UK government yields jumping by around 20 basis points and U.S. Treasuries also selling off, reflecting renewed concern that higher oil and gas prices will bleed into broader inflation. In several markets, short-dated yields have pushed above central bank policy rates, signaling that traders are increasingly skeptical about the prospect of near-term rate cuts and are instead bracing for tighter financial conditions. Nowhere is that shift clearer than in Europe and the UK. Market pricing has moved from expecting cuts to anticipating that the European Central Bank may deliver one or even two hikes over the coming couple of years, with similar rethinking around the Bank of England. Short maturity European yields have risen sharply as investors factor in these risks, and financial conditions in the euro area are tightening well before any official move, raising questions about how much policymakers can actually deliver given already weaker growth and lower inflation than during the last major energy spike. In the U.S., the picture is more finely balanced but pulling in the same direction. Markets now expect only a small number of rate cuts this year, and those not until late in the calendar, as front-end inflation expectations rise on the back of gasoline and diesel, even while longer-term measures remain anchored and support Federal Reserve credibility. Complicating matters, the labor market is showing signs of strain, with payrolls recently surprising on the downside and unemployment nudging higher, which makes aggressive hikes hard to justify even as central bankers are reluctant to ease into an energy-driven inflation pickup. This tug-of-war means bonds are not providing the usual diversification when growth worries and inflation shocks hit at the same time, a key challenge for traditional balanced portfolios. Investors are responding by moving up the quality spectrum but hugging the very front end of the curve. Record flows into short-term treasury vehicles and a visible rush into cash highlight a pronounced flight to safety, even as longer maturities cheapen. That pattern fits with a world where allocators want liquidity and policy shelter, but are wary that standard duration hedges may not work if the oil shock turns into a sustained stagflation episode. Those same concerns are increasingly visible in credit markets, especially at the more opaque end. Headline credit indices still look relatively orderly, but stress is building beneath the surface, particularly in private markets. Lenders that focus on highly leveraged borrowers who cannot tap traditional banks are drawing much closer scrutiny, with the debate shifting from eye-catching deal flow to the actual quality of underlying collateral and the robustness of valuations. One large private credit platform now faces record short interest around 15%, underscoring skepticism about how sustainable current marks and structures really are if growth slows and financing costs stay high. There are also signs of strain in parts of public corporate credit. Certain well-known investment-grade issuers have seen the cost of insuring their debt jump to levels last associated with systemic stress episodes, reminding allocators that even apparently solid balance sheets can reprice quickly when business models are questioned. On the household side, higher fuel and utility bills are set to squeeze weaker balance sheets more than in previous cycles, raising concerns about consumer credit performance if wages fail to keep pace. In response, many investors are rotating toward higher quality and more liquid credit exposures, using them alongside short-term government paper as part of a broader de-risking playbook. The currency side of that de-risking is increasingly dominated by the U.S. dollar. The foreign exchange backdrop is being reshaped by the same forces driving rates. The U.S. dollar has firmed alongside rising treasury yields, reinforcing its role as the primary global haven, even as some traditional safe currencies and gold have delivered less consistent protection during recent shocks. This dollar strength is especially important because oil and liquefied natural gas are priced in dollars. So every uptick in the currency magnifies the effective energy bill for importers in Europe, Asia, and emerging markets. Outside the U.S., the combination of higher commodity prices and a stronger dollar is feeding more acute inflation pressure. Natural gas disruptions from key Gulf producers, expected to last at least several weeks, are already pushing up power and heating costs in regions that rely heavily on imported supply, while weaker local currencies limit the ability to absorb a shock. By contrast, the U.S. benefits from growing non-OPEC production, which provides some cushion and supports the currency narrative. For allocators, the FX channel is therefore a key amplifier of the energy shock and a critical variable when assessing regional equity and credit risk. To understand that shock, we need to turn directly to commodities. Commodities, and energy in particular, sit at the heart of today's regime shift. The current Middle East conflict is being described as the most serious disruption to global energy flows since the 1970s, with shipping through key choke points facing elevated risk and parts of regional production either shut in or rerouted. Estimates suggest several million barrels per day of oil supply have been taken offline, and as much as a fifth of globally traded oil and liquefied gas is affected through diversions and delays. Brent crude has surged from around $70 to well above $100, at times spiking toward $120 before pulling back, while price benchmarks for certain Middle Eastern grades are trading at a notable premium, reflecting acute regional tightness. Policymakers are scrambling to cushion the blow. G7 finance ministers are weighing a coordinated release of several hundred million barrels from emergency reserves, and global inventories are large enough on paper to offset a prolonged disruption to one major shipping lane. However, past experience suggests such releases may only temper prices temporarily, and the U.S. Strategic Reserve in particular has already been drawn down to low levels, limiting its firepower. At the same time, some Gulf producers are cutting output as storage fills, while rising non-OPEC production, especially in the U.S., provides a partial offset that may prevent the most extreme spikes but not eliminate a risk premium. The broader macro implications of sustained triple-digit oil are significant. Analysts estimate that keeping prices in the $100 to $120 range for an extended period could shave more than a percentage point from global growth and push inflation higher, raising stagflation risk and keeping risk premia elevated across assets. Consumers are already feeling the strain as gasoline and diesel prices rise, with confidence weakening in sectors like airlines, cruise lines, and other travel-related industries seeing sharp equity underperformance. Natural gas disruptions from countries such as Qatar and the United Arab Emirates are compounding the problem, especially outside the U.S., by lifting heating and power costs just as central banks face pressure to stay restrictive. Looking ahead, the key variable for allocators is duration. If shipping risks ease and damaged infrastructure remains largely intact, current volatility could still be remembered as a severe but temporary supply shock, with energy prices eventually retreating and inflation pressures moderating. In that world, today's risk-off moves across rates, credit, and equities might gradually reverse. If, however, disruptions and infrastructure threats persist beyond a few months, the embedded risk premium in oil and gas is likely to become more structural, reinforcing stagflation concerns, keeping bond yields elevated, and pressuring earnings and household balance sheets. That fork in the road will go a long way toward determining the cross-asset regime for the rest of the year. Across assets, the picture is one of growing tension rather than outright panic. Equities are volatile but have not fully repriced the combination of higher energy costs, softer labor data, and less generous central banks, while rates markets move steadily toward a higher-for-longer narrative, especially in Europe and the UK. Credit is outwardly calm, but shows mounting stress at the private and lower-quality ends, even as flows chase very short-dated government paper, and a stronger dollar is amplifying the energy shock for import-dependent economies. At the core, an unusually severe Middle East supply disruption is driving oil and gas higher, raising stagflation risks and challenging the diversification properties of traditional 60 to 40 portfolios. For allocators, the key watch points now are the persistence of Gulf shipping and infrastructure risks, the evolution of earnings expectations under triple-digit oil, and any shift in central bank rhetoric as inflation and growth data arrive over the next few weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.